Now let us open the second case study of the event study analysis. Basically here, where we are going to look how the lockdown announcement of the government has affected the market performance of the Indian financial market. Again, we are going to use the same three packages. However, already we have installed and we have already uploaded for this session. So there is no need to do the same again. Then the similar steps will follow. The first will define the event date. So here the event date is COVID event date that happened the lockdown announcement on the 24th March 2020. So that has we had stored here. Once we define the event date, what we have to define now, what is the estimation window and what is the event window. So here the estimation starts here this. So COVID, so what we have event date minus 60, that means the estimation starts prior to the event date. So if we can use the event study timeline, so basically here what we are having, that event has occurred here, that is the 24th March 2020. The event is here, event start windows is starting here, that is the 60 days prior of that on the 24th January 2020. So here we are having the starting window of that, and when we are going to end the just before the 11 days. So that is on estimation starts 24th January 2020. So here it is the so what we have, the starts on date is 24th January 2020, and it is going to end the 13th March 2024. So this is the basically what we have. We have the estimation window. So these information will use to calculate the normal returns here. Now let us start event start window. So event is starting happening the 14th March and ending as the 3rd April. So 10 days before this. So basically here the 14 days. So here is starting 14th March 2024, and 10 days after this, that is on the 3rd April 2024. So this is what we have as the event window. Now this will be using to calculate the abnormal returns and the cumulative abnormal returns. So that's the study we have. So this is the here what we have. Here we have event date. Now let us calculate the abnormal return and the cumulative abnormal return. First we'll calculate the normal returns, then we'll make the difference of this, then we'll perform the significance test. Now once we have defined those, now we are calculating the downloading the data. So as we have told that we are going to test this on the Nifty 50 as we are taking as a market portfolio, and we are also going to see the what is happening in the IT industry. So here NSCI basically for the Nifty 50 and the CNS IT is basically the NSE stock index for the IT sector. And here we are taking the data from 1/1/2019 to 13/12/2020. So let us get this. So here we can see both the IT. Again, we have the open price, high for that day, low for that day, and closing price of that day, and here the volume, and here the adjusted price we have. Similarly, for the Nifty 50, we have the opening price, high price, low of the day, and closing prices and volume of the trade and the adjusted price we have. Now, once we do that, we are using the adjusted price. So first we are extracting the adjusted price from that data set. So Nifty and IT. So here you can see we have the Nifty prices, that is the adjusted, and similarly we have the NSE IT prices here for this. So we are using adjusted prices for this. Now that those are the prices. So now what we will do, we will calculate the returns. So we are going to chart series. So let us say Nifty prices. So here we can see how the prices has evolved of this. So here you can see in the March there was the lockdown, and there have been a drastic change once the announcement has happened of the COVID-19. Now let us see, is it the significant we have? So next we are going to calculate the same as the chart series, that is of the IT prices. So here we can see this is the for the IT prices how it has. Well, again we can observe a significant drop in the March 2024 when it has been the lockdown has been announced. Now let us calculate the returns here. So we are calculating the Nifty returns and IT returns using this function here. So let us again draw the chart series of Nifty returns. So here you can see the Nifty return we have drawn, and here you can see the March 2024 around there is the huge negative return we have. So that means there have been the price drop, significant price drop here we have in this March 2024. Similarly, we can observe that the IT returns the IT returns we can again similar effect we can observe here, that there is the huge price drop into the negative returns. Now let us calculate the abnormal returns and the normal returns. So before that, what we have to subset those data. Again we are using the similar steps here, and we are calculating the estimation IT, that is the for the normal returns we have made the subset data, that is here we can observe this. For the 60-day data we have separated. Similarly, we have the event IT. So for this event IT, that means for the event window we have calculated 10 days returns separated here. Now once we have done, now let us do the same task for the market returns. Now let's estimate the market model. So the market model, again using the same formula we have created that. Now let us find out the alpha and beta of the market returns, that is for the alpha hat and beta hat of that. Once we do that, then we have to calculate the abnormal return and cumulative abnormal returns. So we are using these functions here to calculate the expected return, that is the normal and abnormal returns here. So once we have calculated the abnormal returns, now we are also calculating the cumulative abnormal returns here. Now let us visualize both these. So this is the abnormal returns of the IT industries due to the COVID-19 event. So this is we have. Similarly, we can plot the cumulative abnormal returns for this IT industries. Here we can observe this here. Now let us take the significance of that. So for that, again we'll calculate the mean, standard deviation, number of observations. Then using those information we calculate the t statistics. Then we'll perform the t test here. So let us get all those information. So here we can see those returns here. So what we can observe, mean abnormal return is 0.03, standard deviation is the, and t stat is 0.57, and the p value is 0.574. Here we can observe 0.54. So that means by looking the p value, since it is closer to, so here again what we can observe that the p value is closer to 1, that means we have to accept the null hypothesis, and the null hypothesis is that abnormal return is equal to mean value of the abnormal return is equal to 0. That means again we are accepting that abnormal return is equal to 0. That means the lockdown does not have significant effect if we are considering the abnormal return. Now let us go to the second, that is the cumulative abnormal return. So here we are conducting the test, so we are failed to reject null. Now let us test the mean, standard deviation, and the t statistics, the test statistics we perform, and here we have the results. So what we have the results here, the mean value of the cumulative abnormal returns is 0.417. So in case of cumulative abnormal returns, the mean value what we have 0.0147, and the p value what we have, the p value we have p value is 0.006, that means it is closer to 0. So we have to reject the null hypothesis. Rejecting the null hypothesis means that the cumulative abnormal return, there is the significant change in the cumulative abnormal return, and what we have the positive change. So that means when there was the announcement of the lockdown, there was the positive effect on the IT industries, and its price has basically jumped. And it is quite logical to assume to believe that, because when you can observe that when there have been the COVID lockdown, for example online classes, the edtech companies, lot of uses applications of IT softwares and all has increased, and those has a positive expectation effect on the stock prices of the IT sector. Therefore there was the jump in the positive effect on the IT returns. So that's we have conducted these two case studies for the event study analysis. In one case we have observed, in both the cases what we have observed, that there is no significant effect if we are using the abnormal return. However, when we are using the cumulative abnormal return, the event has a significant effect on the returns. In one case there was the negative return because of the merger announcement. On the other hand, when there was the COVID-19 announced, what we have observed, there is the significant positive impact on the IT return. So that's how we conduct the event study analysis using the R Studio. Now let us go to the second part of this case studies, that is how to calculate the value at risk models. So for that, what we will do, again let us clean the windows here. So by clicking on this, we are deleting all the files, everything here. Then we can also clear the console using the Ctrl+R button. For that, value at risk for the stock prices first we'll calculate it. So here what we have, here we have this, the value at risk script file. Again, we are using the same packages, that is the quant mode and the performance analytics to conduct the value at risk studies. Then the first thing what we have done, we have collected the data, historical data for the Nifty 50. Then we have calculated the log returns. Then we find out the summary statistics of those returns. Then here we have decided that portfolio value is 100 crore rupees and the holding period is 1 day. Then we calculate the value at risk using the 3 different methods here. So let us first get the data here. So once we get the data, here you can observe the NSI. Again, it has the open price, high price, low price, close, volume and adjusted price. Now we calculate the returns. To use the returns, we have used the close prices. So that Nifty returns is basically the object name where we are going to store the returns data. Daily return is the function which we use to calculate the return, and here we are using the log form to calculate the return. So basically we are using this log formula to calculate the return, that is so we calculate the return using the log function of price of T and Pt minus 1. That's what we use the function to calculate the return. And to implement that, we have used the function daily returns here. Now let us take the summary of that. So if you are taking the summary, so here we can observe that the minimum value is minus 0.139 and the maximum value is 0.084, and on an average the return is 0.005679. Now once we calculate the summary statistics, which will give us the little bit information about the returns, next is we are fixing the portfolio value here. So the portfolio value we have 100 rupees 100 crore. Now we are going to calculate for 1 day how much we are going to lose in maximum we are going to lose in 1 day when the portfolio value we have 100 crore rupees which we have invested into the Nifty 50. So now let us say here the holding period is 1. Now first we are using the historical vector autoregulation first we are calculating the historical value at risk method. So for that what we do, first we calculate the value at risk using the formula value at risk Nifty returns, and the confidence interval we are getting 0.95. Method we are using the historical, and portfolio value is equal to the portfolio value which we have defined rupees 100 crore. So historical value at risk. Now what is the loss we are making? Historical loss is the absolute value we are taking. Now let us see what is the absolute value we have. So here we can observe that the maximum, so it should be negative. Here we are taking the absolute value because it is implicit when we are talking about value at risk, that means we are making a loss, maximum possible loss. So if we have the 100 crore rupees, then what we are observing that here the maximum loss, possible loss is 1 crore 66 lakhs and 797 rupees. So that is the maximum loss we can get in 1 day, while we have the portfolio value of rupees 100 crore which is being invested into the Nifty 50 index, and this is for the 1 day we have. Now let us take the parametric value at risk method. So for that what we are using, that value at risk, same function we are using, that confidence interval is 95. Method we are using now Gaussian for the parametric value at risk. So let us see here. Then the maximum loss here possible is 1 crore 95 lakh 21,176 rupees. Next, we are going to use the Monte Carlo method, that is the Monte Carlo simulation method. So for that, what we have, the method is modified. So here the function is VAR to calculate the value at risk. Again, for which this nifty return we are calculating, and the p value is 0.95, that is the confidence interval is 0.95, and method is modified. So let us calculate this here. This we have. Now let us visualize all those value at risk into a single chart here. So histogram we are making. This is the first histogram where what we have. This is the normal distribution we have. Now let us put those value at risk different methods here. Now if we look here, that the historical value at risk is predicting less loss compared to the Gaussian and Monte Carlo value at risk approach. In the parametric value at risk and the Monte Carlo simulation, what we are having almost the same amount of value at risk. So how we can make the interpretation here? So that means if you are having the historical value at risk, so then we are making the loss of 1 rupees. So what we can say here, the maximum possible loss with 95% confidence during 1 day for the portfolio value of rupees 100 crores is about rupees 1 crore 66 lakhs. Or the other way to interpret is that there is 5% probability or chance that the loss of the portfolio value can exceed than rupees 1.66 lakhs over 1 day when the portfolio value is rupees 100 crores. So either we can use this approach or this approach to interpret the results. And another thing what we can observe here, in the case the maximum amount is the loss is given by the both this Monte Carlo and the this parametric approach, both gives almost a similar value, while the historical value gives the lesser amount for this. So this is for the individual stock we have calculated the value at risk. Now let us calculate the value at risk for the portfolio. So again let us clean this window here. Now again we are using the same packages. So first we get the data. So we are getting the data of Reliance and the TCS, which is on of the Bombay Stock Exchange, that is BSE. So this both stock prices we have downloaded here. Now let us calculate the daily returns. Now we are combining the returns to make the portfolio here. So the portfolio returns are merging both the data here. So the portfolio column names we have. Now what is the weights we are assigning? That is how much a percentage of the total amount invested into the TCS and how much of that is invested in the Reliance. Here the weight we are putting 0.5, 0.5, that means the 50% of the total amount is invested into the Reliance and the 50% is invested into the TCS. So here we are defining the weights. Then what we are doing, we are calculating the portfolio daily returns using the portfolio here. So for that, what we are calculating here this. So you might remember from the discussion, calculating the portfolio return, what we do, that the weight assigned to the first portfolio and the return of the first asset, then the weight assigned to the second asset and the return of the second asset. So basically the portfolio return is nothing but the weighted average we use. So the same thing here, we have calculated that daily return here, this multiplied by weights. Once we calculated the portfolio returns, now we have to calculate the covariance of the portfolio matrix here. So we have calculated the covariance matrix. Then we calculate the mean and standard deviation of the portfolio. And here the portfolio value, the total amount we have rupees 100 crore. Again, the holding period is 1 day. Now again, we are going to calculate all three different methods to calculate the value at risk. First, we are calculating the historical value at risk. Again, at the confidence intervals of 95%. And here we have the historical value for 1 day is the 2 crore 47 lakh 3,774. So maximum loss with the 95% confidence interval for 1 day is 2 crore 47 lakh 3,774 when the portfolio value is rupees 100 crore. Now similarly, we are going to calculate the parametric VaR. Then the loss is 2 crore 33 lakhs, and we are also going to use the Monte Carlo. Now let us see here. So in this case, now we can observe clearly here that the minimum among all these three, the minimum loss expected is given by maximum loss, but in terms of the value is lowest is the historical, then the Monte Carlo method, and the parameter is giving the maximum. So in this case, what we can see here, so we can observe here that again we can interpret that those results, that the maximum possible loss of the portfolio value over 1 day with 95% confidence, that is the 95% probability, is that we can lose almost 2.47 crores if we are using the historical method. Or this can be interpreted as other way, that there is 5% chance or probability that over 1 day the portfolio value may lose more than rupees 2.47 crores in the portfolio. In the portfolio, what we have, the two stocks we have taken. So that's how we conduct the value at risk using the three different approaches, whether for the stock returns or whether for the portfolio. Here in this specific example, we have taken the portfolio is the combination of the two stock prices. So that's all for the today's lecture, and this happens to be the last class of this course. I hope everyone have enjoyed this course and have the fruitful results. All the best for your career next ahead, and thank you so much joining me with this course and completing the journey of this course. Once again, thank you so much.